We're joined by someone with in-depth experience of U.S. economic policy. Frank Lavin is a former undersecretary for international trade at the U.S. Department of Commerce. He's currently chairman of public affairs at Edelman. He joins us live now from Hong Kong. Frank, good morning. Thanks very much for joining us today.
Glad to be here. Thank you.
Will the Fed statement be enough to boost confidence in the markets?
I think it's a necessary precondition, Lindsay, but I'm not sure it's sufficient. I think there are so many other elements to market dynamics that this is an important building block, but I think the market's going to be wary after the sharp volatility of the last few days. We're not going to see, I think, steady increases, steady recovery over the next week or so unless we see other tactics.
I mean, to talk about the other tactics, because the Fed has said it's prepared to employ additional tools. Does that tell us that possibly in Jackson Hole in a couple of weeks we'll have a repeat of last year with Mr. Bernanke announcing QE3?
Yeah, but the trouble with QE3 is there doesn't seem to be the political support for that kind of move. I think of the $2 trillion released in QE2, $1.5 trillion is still in banks. So we see a classic liquidity trap where there's plenty of money available, but there's just not the business confidence to take advantage of it. So I don't think a QE3 is what the markets need right now.
So what do the markets need right now, Frank?
I think it's step-by-step rebuilding business confidence, that we look at pro-growth economic policies out of Washington, and we look at a operating environment where businesses have certainty and can feel comfortable about the likelihood of return on investment. And so that sort of step-by-step return to the norm where we're going to see a virtuous cycle unfold of investment, employment, consumption patterns all slowly going the right way.
Are you confident?
We've got to get out of neutral.
Very quickly, Frank, are you confident that a divided Congress, that a president that's approaching the next election can deliver all that?
I think there's a basis for skepticism. I think you're right. There's nothing we've seen so far this year that's been edifying. I mean, I think the markets are reflecting a lack of confidence in leadership. And by the way, I don't think it's specifically a U.S. issue, but the world looks to the U.S. for economic leadership. But I think we happen to be in an era of small men, if you will, or small men and small women, that I don't see anybody out there with solid economic leadership. Canada's doing well, Sweden's doing well, but really the major economies are not doing well.
Frank, start off with these trade numbers. I mean, the surplus biggest in more than 2 years, not something the U.S. would like to see.
Well, I think from a U.S. perspective, it's not a question of surplus or deficit, but it's a question of things such as market access. Can the American companies sell their goods into China, and related issues such as intellectual property protection, indigenous innovation, and so forth.
And are we seeing improvement there? Are we seeing improvement in those areas?
Well, yeah, we saw from the statistics very nice rise, 22% rise in imports in China. That correlates with U.S. figures, which are showing in the low 20s increase in U.S. exports to China. China is going to account for about $100 billion plus of U.S. exports this year. I mean, it's a very large market for U.S. exporters. So the exports themselves are bubbling along, but intellectual property rights remains an issue. Indigenous innovation remains an issue.
I mean, Frank, you've been the key negotiator between the U.S. and China, the U.S. and India. Just give us an idea of how these negotiations take place, the circumstances, the discussions, how it unfolds.
Sure. Well, China's been on a path of liberalization now, Mark, for about 30 years, but it is from a Western perspective, we would say it's a somewhat slow or somewhat deliberative path. And they're going at their own speed, at their own pace, according to their internal constraints. What we're looking for from a U.S. perspective is how do we incentivize or accelerate that very healthy trend. We think it's good for China. We think it's good for the U.S. And indeed, we could say China's economic boom over 30 years has taken place in large part because China has liberalized and has opened up, and the sectors that are the most open tend to be the sectors that are doing the best in China. So that's the perspective from the U.S. to try to get China to buy into that view of keeping liberalization on path. I've got to tell you something, though. Since the global financial crisis in 2008, we've seen a real slowdown and even some retrenchment in some of that liberalization, because I think what happened in 2008 was it called into question the model. Does that Western model of open markets really lead to the greater prosperity, or does it also bring problems with it? And that question is front and center in Chinese decision-makers' minds right now.
As you say, I mean, that question is very much in the forefront of their minds, and potential exports is very much at the forefront of their minds, Frank, because if the global economy slows, China's not going to export as much. Maybe that means they're not going to hike interest rates as much, despite concerns about inflation. I mean, does China really have something to think about now when it comes to global growth, when it comes to exports?
Mike, I think you put your finger on it, and there's probably tension between long-term and short-term policy requirements in China. Over the long run, exports from China simply aren't going to play the role they've played over the last few decades. Exports can no longer be that primary locomotive of economic growth. But in the short run, it's the most powerful mechanism they have to keep growth on track, and I think they need to respect that. So they know, I think when you talk to leadership, they've got to balance their economy, and they've got to balance that currency a little bit better, stimulate domestic demand. But that's a longer-term phenomenon. So we'll see these numbers, I think, change at the margin over the next few years, but it can be 5, 10, 20 years before they fully have consumer spending on credit to where they'd like it to be.
Frank, it's been a pleasure. We'll speak to you soon. Frank Lavin there from
Thank you.
Edelman.
Thank you.
He's Edelman Chairman of Public Affairs.